My guest today on the spot is Greg Weldon of Weldon Financial. He's up next. Here to look at the outlook for 2014 with me today is Greg Weldon. Greg, good to be back with you.
Yeah, hi Danielle, it's great to see you again.
Greg, can you believe the last time we saw each other was when the Fed had just announced QE3? Here we are now at the end of 2013. Central banks continue to be accommodative. How do you see things set up?
Well, it's interesting to backtrack because when we did last speak and the Fed was introducing QE3, it wasn't long before that when people didn't believe QE3 would ever even be announced. So that's an interesting point just for perspective. And we're kind of now reversing that 180 to where the talk is tapering. The opportunity probably is here for the Fed to do it. They kind of want to do it. I don't think that necessarily the macro backdrop is what they want to see to facilitate that tapering. But I think the psychology may be as important, and the market seems willing to accept that tapering is coming, so maybe the time is right for them to strike here. I think there's a lot of extenuating circumstances and tangent discussions to be had around that for sure, though.
I'd like to now look at a quote with you, Greg, from Janet Yellen, set to be the new Fed head in 2014, where she says, "This is challenging. We are in unprecedented circumstances. We're using policies that have never really been tried before, multiple policies, and we're trying to explain to the public how we intend to conduct these policies." So it is a work in progress, and sometimes miscommunication is possible. Greg, I'd like your interpretation of this quote.
Well, it's the old central bankese, that archaic language that goes round and round without trying to say, saying as little as possible. I think the translation for me is very straightforward. We don't know what we're doing. We're flying blind. We're flying by the seat of our pants and hoping that things turn out okay. The stakes are huge. This is high stakes poker, at the maximum level when it comes to monetary policy. And I always, you've seen some of my conference presentations. I like the ending slide that sometimes we use where it shows a guy traversing the Grand Canyon on a tightrope with a little balancing pole. And to me, that's been Ben Bernanke, will be Janet Yellen, as they try and, walk across this cavern where you tip too far. It's a reflationary bubble. And if you tip too far the other way, we're back into a deflationary debt dynamic. So, man, I don't envy them their job, but I think it is telling that this transparency maybe has gone a little too far, in the sense that, they have division on the Fed as to what to do. They come off looking like we're not sure. And I don't think that necessarily translates the best message to the markets, especially as we move forward.
So, Greg, I'm going to ask you a loaded question now, but how do they get out of it?
I don't have an answer for that. I really don't. I think that they're going to have to try and taper and then see what happens. And I think the results could be problematic for them. I think that they've made it very clear. Whenever you hear them speak, they are very quick to add the caveat that we can always go back to buying more. So I think that's important, because that option has to be there, or they've really painted themselves in a corner, because without, this omnipresent monetary stimulus, it's tough to see how markets can remain reflated on their own. And I think that's a big, big question mark for 2014.
Let's turn to the markets now, Greg. Are you worried about anything?
Well, I'm worried about some of the divergences I see, specifically as it relates to the U.S. stock market. We could make a case. You look at net worth in the U.S., just released data by the Fed, $22 trillion reflation from the crisis low. That's impressive, but it's built on equity values, less so housing, which is now rolling over. We've seen a rollover in gold. We've seen a rollover in emerging markets. We're starting to see a rollover in consumer discretionary versus staples. And all of this, monetary stimulus has driven the stock market higher, which has given consumers a feel-good factor. Lower gasoline prices haven't hurt either. And this has then facilitated more borrowing. Stock value portfolio gains is not like getting money in the bank every 2 weeks, like an increased income from your paycheck would be. So to me, to see the level of wealth reflation that's not being matched by growth in deposits at the consumer level, and to see that consumers are now borrowing again very aggressively, I think, you could suggest that the Fed has already set the stage for the next crisis. It's in the stock market, it's in the consumer, and that brings them back into play on the back end of this. So that's what I'm worried about for 2014. But at the same time, as we've spoken before, there's plenty of opportunities out there.
On that note, what are you liking? What are you not liking?
Well, I mean, the dollar is key to all of this. Clearly, the 7,900 level in a dollar index is critical. Dollar renminbi is making new lows. That tends to be the path of least resistance for the greenback. So, on a dollar down scenario, we would love to be long the industrial metals and the precious metals. I think you look at silver, looks interesting, double bottom potentially. You look at the silver mining shares, Pan American, Silver Standard Resources, and then you move into copper, nickel, zinc, some of the base metals. Copper supplies are falling just about in every exchange warehouse from China to London to the U.S. You see there's backwardation now in the LME forwards swaps in copper. You saw a big import number from China on Friday in copper. A breakout in copper above 340 would be technically significant. So we kind of want to like the copper market. We need to see some technical confirmation of that. The alternative scenario would be a strong dollar if tapering's driving real rates up enough to put a bid onto the dollar, then that could be back in a scenario where everything is deflating. It's a question of how fast.
So you're liking copper, that's clear. Is there anything you're absolutely avoiding?
Well, I mean, no. I mean, we tend to, be macro top down, but also technical bottom up. So we want to see when things, meld in the middle. We don't discount any possibility coming from here. I can tell you, doing this 30 years now, this is easily the most uncertain environment. And what I find really interesting about that is how low volatility is in all these markets against that uncertainty. That is an oxymoron. So maybe the play is to be long volatility for 2014.
I guess to wrap things up, Greg, your takeaway on gold.
Well, again, it's a dollar dynamic until the stock markets potentially are exposed for being, overly reflated or an inability to maintain that reflation. Let's not forget, it's not about, seeing stock markets hold here. It's all about growth. They're trying to stimulate growth, trying to stimulate reflation in the macro economy. And, from that dynamic, you need to see mathematical extrapolation in growth rates that we probably are not going to see. That puts the stock market at risk, in my opinion, especially in a tapering scenario. And, in terms of gold, that could be the next boon for gold. If to me, gold has suffered because the monetary authorities have said, look, we will do whatever it takes to protect the backs of stock market investors. So gold, therefore, loses its play as a risk premium dynamic. It provides no yield. This is a hunt for yield environment. That puts gold at a disadvantage. So I think you need a turn in the stock market to put a bid in gold. And I think that's a very possible, potentially high odds scenario for 2014.
All right. On that note, Greg, thanks so much. Happy holidays.
Oh, you guys too. It's my pleasure. You guys are awesome. Anytime. My pleasure.
Thanks, Greg. And thanks for watching this edition of On the Spot. You can email us at newsfeedback@kitco.com or follow me on Twitter @Daniela Camboni. Thanks for watching and happy holidays.